So I think we're ready to begin our session today. So welcome everybody to the Henry Warren webinar session on what accountants wish nonprofits knew about compliance before it's too late. So as a quick disclaimer, this presentation is strictly for informational purposes only. Every circumstance is unique and we recommend you discuss your specific situation with your professional advisors. So just as a quick introduction, today we're going to be talking about, from the perspective of an accountant, what we wish that our MPO clients knew about compliance and financial reporting. And with me today is my colleague, Megan Blosky. We're going to go through these things together. My name is Michael Quinn. I'm one of the assurance managers working at Henry Warren. I've been in the role for about 3 years now, and I work with our charity and MPO clients as part of their financial reporting, year-end work, and their tax compliance work. And so, Megan, quick intro from yourself.
My name is Megan Blosky. I'm a principal here at Henry Warren and have been with the firm for over 12 years at this point. I spend a large amount of my time working with our not-for-profit and registered charity clients, so I'm very excited to present today.
Perfect. So just to kind of lead us off, Megan, what type of financial statements does an MPO require?
Thanks, Mike. So I think there's a misconception here that our clients often have that the CRA dictates the type of financial statements a not-for-profit is required to have. But that's actually not true. The only thing that sort of comes out from the CRA in regards to financial statements with respect to not-for-profits is from the Charities Directorate of the CRA, and that is, of course, specific to registered charities. The Charities Directorate recommends registered charities have an audit when their revenue is over $250,000. But again, that's just a recommendation and not true must have. It is the type of financial statements required by an organization is the responsibility of the board of directors and management to determine. So us as accountants can certainly help you out with that, but that responsibility does lie with the organization. To determine the type of financial statements a not-for-profit needs, you'll want to actually look at your incorporating authority. So our firm is based in Ottawa, Ontario. So we're going to talk today mostly about the Canada Not-for-Profit Corporations Act, which is for federally incorporated organizations. And we're also going to look at the Ontario Not-for-Profit Corporations Act, which is for incorporations incorporated under the laws of Ontario. We'll go into these specific acts and their financial statement requirements in the next couple of slides, but I think it's also important to mention that when we talk about the revenue thresholds for financial statements, those thresholds are based on your prior year financial statements. So in the case of an organization that just completed their 2024 financial statements, those 2024 revenue amounts are going to dictate the type of financial statements they need for 2025. So you don't need to worry about trying to guess what your revenues are going to be for any given year to make sure you have the right type of financial statements. You'll just have to look back at the previous year revenues amount. In addition to understanding the type of financial statements under these acts, you also want to think about, do we have any other external requirements for financial statements? So a lot of our not-for-profit clients receive government grants and other sort of money from foundations or other sources that do have a financial statement requirement in those agreements. So it's important to understand those agreements because even if the act says you need one type of financial statements, if your grant needs an audit, you'll want to be getting an audit done to satisfy the requirements of those agreements. Before we delve into the types of financial statements, I just want to explain the hierarchy of financial statements that we as public accountants do issue. So we'll start with the first tier, which is now called a compilation engagement. About 3 to 5 years ago, these were called notice to reader financial statements, so you might be more familiar with that terminology. A notice to reader financial statement is one where we are just a compilation as we call it now, is a financial statement where we are just compiling the information to us provided by the client. So we're not giving an auditor review, opinion, or conclusion on those. We're just reviewing the information that has been sent to us. The next level, the second tier, is a review financial statements. So a review engagement is what we call a negative assurance engagement, because in that case, what we are saying is that we do not see any reason these financial statements are not materially correct. So there is some form of assurance given, but not as much as in an audit engagement, which is our third and final tier. So in an audit engagement, we are saying we believe the financial statements are materially correct. So that is positive assurance. As we go up the tiers, we also go up in price point because of the level of work involved in producing those financial statements as public accountants. So that is why when an organization can get away with a compilation engagement or maybe a review instead of an audit, that will often be of interest to the board of directors and management.
Yeah, that's great. Thanks, Megan. Now, we noted that there's Canada Not-for-Profit Corporations Act as well as Ontario. So what does that look like in terms of financial reporting requirements under the federally incorporated not-for-profit organizations?
Yeah, so the first thing we have to do when we look at the requirements under the Canada Not-for-Profit Corporations Act is determine whether your not-for-profit is a soliciting corporation. A soliciting corporation is a defined term under the Act. There are full examples and definitions available on the government's website of a soliciting corporation. So I would definitely recommend everyone check that out if you are federally incorporated. But briefly, what it qualifies someone or a corporation as a soliciting corporation is three different conditions, and it's if you meet any of these conditions. So the first one is you have to receive, to be a soliciting corporation, over $10,000 of revenue from three sources. So the first source is donations and gifts from persons who are not directors, officers, or employees of the not-for-profit. So that would generally be donations and gifts from what we would consider arm's length individuals from the corporation. The Act has a bit more of a specific definition that it also can't be from the spouse, parent, child, aunt, uncle, niece, nephew of a person who is a member, an employee, an officer, or a director. So you kind of have to look at one branch of the family tree in every direction in that case. The second criteria is that you have not received grants or similar funding from any level of government or government agency. So, for example, a government agency would be like Global Affairs Canada. The third criteria is that you can't have received over $10,000 of grants or donations or grants or similar funding from a corporation who has then in turn, that corporation has received money from a government or non-grants in excess or non-members in excess of $10,000. So those three criterias are considered an aggregate. So if you have donations from people who are not related to the corporation of $6,000 and you have a $5,000 grant from the government, even though those are each individually under the $10,000 threshold, because in aggregate they're over, you would be a soliciting corporation. Since soliciting corporations receive public money, either from the government or people who are not members or related to the organization, there are more tightly controlled thresholds for the type of financial statements a soliciting corporation needs. We've listed them out here on the slide. Again, you can find more information on the government's website, so I'll just quickly go through them for you. So the first threshold is $50,000 or less for a soliciting corporation. So if that's the threshold of revenue that applied on your prior year financial statements, you have two options. The first option is to not appoint a public accountant, and by an annual unanimous resolution, you can then have a compilation engagement. So you would have to have a motion passed by the entire members of the organization that they do not want to appoint a public accountant, such as Henry Warren, and are also accepting of only doing a compilation engagement. If you do appoint a public accountant, then you have to have a review engagement, so you can't downgrade to a compilation if you elect in your minutes to appoint a public accountant, or you can also choose at any time to have an audit engagement. For the next category of $50,000 to $250,000 of revenue, At this point, you must appoint a public accountant. So you'll want to make sure that's documented in your meeting minutes. And then an audit is the default required for this threshold of revenue, but you can pass a special resolution to instead have a review engagement, which would be a step down in the type of financial statements and then therefore most likely cost. The final threshold for soliciting corporations is revenues over $250,000. In this case, you're out of choices. You must appoint a public accountant and you must have an audit. So you just need ordinary resolutions for those since you're not electing to downgrade. Finally, for non-soliciting corporations, so again, these are corporations that don't receive money from non-members and they don't have over $10,000 of money from them and or donations and grants from governments. Because they're not, these not-for-profits aren't using public money, you can see the thresholds are much larger in this case. So if your revenues are under $1 million, then if you do not again appoint a public accountant, you can pass an annual unanimous resolution to have a compilation engagement. If you decide you want to appoint a public accountant, then the default becomes a review engagement, or you can once again elect to upgrade to an audit engagement. If you're a non-soliciting corporation who has revenues more than $1 million, just like for over $250,000 for a soliciting corporation, you're out of choices. You have to appoint a public accountant and you have to have an audit engagement if your revenues are over $1 million.
And so we've talked about the federal. How does that look under the Ontario legislation? Does the concept of a soliciting versus non-soliciting organization exist under the provincial legislation?
I would say almost, but of course they make it slightly different. So you do need to be aware of the definition under each act. In a Ontario corporation, it is instead called a public benefit corporation instead of a soliciting corporation. So when we're looking at not-for-profits incorporated in Ontario, we need to first assess what is a public benefit corporation and if the not-for-profit fits that definition. So once again, this is fully defined under the Act. On the internet, you can find examples and more information. So if you are incorporated in Ontario, probably a good idea to review that. But generally, a public benefit corporation is a corporation that has received more than $10,000, so same threshold as a soliciting corporation, of revenue either from donations and gifts from persons who are not members, directors, officers, employees of the corporation. So again, arm's length individuals. And then we also have the same criteria that you can't receive in aggregate more than $10,000 of grants or similar funding from government or government agencies. So again, it's an aggregate total of those two. So you have to look at your donations from arm's length individuals and grants to see if those two amounts equal more than 10,000. How this differs from the definition of a soliciting corporation we just reviewed is there's no look-through reel to a corporation if you receive money from a corporation that has, in fact, received money from non-arm's length individuals, from arm's length individuals or from the government. And there's also no requirement to kind of look at the different branches of the family trees. It only looks specifically at people who are members, officers, directors, or employees, not their immediate family members. So it's a bit more of a narrow definition in Ontario. Once we have established if you're a public benefit corporation or not, we can then go on to determine the type of financial statements you need. So looking at those who are public benefit corporations, the thresholds are different than the federal ones, but normally the requirements under them are pretty similar. So if you're a public benefit corporation who has $100,000 or less of revenues, then you can pass what they instead call an extraordinary resolution, which is 80% approval, to not appoint an auditor. So they refer to it as an auditor, not a public accountant. If you pass that resolution to not appoint an auditor, then you can pass another extraordinary resolution to dispense of an audit and a review engagement. And as a result, you would then just need to have a compilation engagement. If your revenues are between 100,000 and 50,000, the default in this case becomes an audit engagement. But again, they give you the option that if you pass an extraordinary resolution, you can instead have your accountant prepare a review engagement, which is the middle tier of financial statements. You would need to pass, and that would need to be passed with an extraordinary resolution. If your revenues are more than $500,000 as a public benefit company, again, out of choices, must appoint an auditor and must have an audit engagement. When we look at non-public benefit corporations, you can see the thresholds are actually half of what they are for federally. So that's why it's so important to understand which statute you're incorporated under. But if you're a non-public benefit corporation whose revenues are 500,000 or less, again, you can pass an extraordinary resolution, which is 80% approval minimum, to not appoint an auditor. Then you can pass another extraordinary resolution to dispense of an audit and a review engagement, which would instead just lead you with requiring a compilation engagement. Once your revenues are more than 500,000, the default becomes an audit, but you can pass an extraordinary resolution to instead have a review engagement. So this is different than the federal ones because at the top federal soliciting, you have to have an audit, but for Ontario, you can get away with just a review engagement once your revenues go over 500,000.
Okay, so now that we've kind of gone over the requirements for the financial reporting side of things for an MPO, does an MPO have to file a tax return?
Yeah, so actually, depending on the nature of your organization, you could have up to 3 filings required for any year. So I'm going to take you through them. So the first one here is a T2 corporate income tax return. So this is the same return that any for-profit corporation has to file. So any corporation that is an NPO but is not a registered charity will have to file a T2 for its fiscal year. As a not-for-profit, you are exempt from taxes under the Income Tax Act. So the filing of the T2 return will not result in a balance owing, but it is still a filing obligation. And the deadline is 6 months after your fiscal period end. Going along with the T2 is what we call a 1044 nonprofit information return. So this return is specific only to not-for-profits, again, that are not registered charities. It is normally completed as part of the T2 engagement, but the CRA still requires that this be paper filed. If you only need to complete a T1044 any year if you meet one of the 3 criterias. So the 3 criterias required to file a 1044 is investment income in excess of $10,000 in the current year. At the end of the previous fiscal year, you had over $200,000 in assets, or you've had to file a 1044 before. So once you file one, you always have to file one. The 1044 is also due 6 months after year end, along with the T2 engagement. And the penalty for late filing a 1044 is $25 a day to a maximum of $2,500, so $2,500. So it can be quite a painful penalty. So you'll want to ensure if you have an obligation to file this, that it is being filed within the 6 months. Next, we're going to switch gears. We're going to talk about registered charities. So all registered charities are not-for-profits, but not all not-for-profits are registered charities. So it's important to understand the distinction if you're just a not-for-profit, which is the T2 and 1044, or if you're a registered charity, you actually no longer have to file a T2 and 1044 because instead the CRA requires you file a T3010 registered charity information return. In the year your not-for-profit becomes a registered charity, you will have to file a T2 and a 1044 if applicable up to the date of immediately before you were granted charitable status. And then from that date that you were granted charitable status to the end of the fiscal year, you'll have to file a T3010. Going forward, you would only have to file a T3010. The deadline for a T3010 is 6 months after year end. The CRA has not yet allowed for electronic filing of this return either. So it can either be paper filed with them, or you can file it electronically through either your represent a client access if you're a representative of the not-for-profit, or if you are a director's, you can file it through your My Business account. There isn't a monetary penalty for failing to file a T3010 by the 6 month deadline, but it can actually lead to a revocation of your charitable status, which is probably a much more significant penalty than any financial penalty. So you'll want to ensure, if you are a registered charity, that your T3010 is being filed by the deadline so you don't lose your charitable status. If you have more questions about what is a T3010 and what goes into completing it, Henry Warren actually has another webinar on that topic, so you can go to our YouTube channel and check that out. The final return is a T3 Trust Information Tax Return. And I know what you're thinking. You're probably thinking, but we're talking about not-for-profits and registered charities. Those aren't trusts. Well, there's actually a sneaky rule I find in the Income Tax Act where if you are an incorporated not-for-profit and your not-for-profit's main purpose is to provide services such as dining, recreational, or sporting facilities to its member, it is going to actually be deemed in the eyes of the CRA to be a trust. Not-for-profits of this type, they have a threshold for investment income of $2,000. Any investment income under $2,000 will not be subject to tax, but any investment income over $2,000 will be subject to tax. And how you pay and report that investment income is by filing a T3 return. One important note on that, because I think this often comes as a surprise to these types of not-for-profits, is because the type of trust this return is, it's not a graduated rate trust. So all of your investment income will actually be taxed at close to 50% over that $2,000 threshold. So you'll want to ensure you're budgeting for that in your financial statements and internal planning. This type of trust is always going to have a December 31st year end, so aligning with the calendar year. So regardless of what the fiscal year end of the not-for-profit is, it's always going to have to file a December 31st T3 if you fit into this category. The T3 and any balance owing on it is due 90 days after year end, so that would be March 31st. And failure to file penalties or accrued interest on any outstanding balances will also apply.
So beyond those tax returns, are there any other returns that an MPO needs to file in order to stay compliant?
Yes. So your incorporating body has special returns you also have to file in addition to the CRA filing requirements, which we just went over, and in addition to your financial statements. So if you're created federally with Corporations Canada, you have to file your annual return through them. Soliciting corporations will also need to upload a copy of their financial statements when they complete this filing. If you're incorporated under Ontario, the Ontario government changed the rules during COVID. So before, an annual return used to be always filed as part of your corporate tax return, but now it's a separate filing through the Ontario Business Registry. So you'll want to be sure you get a sign in for there and are able to file your return when the time comes each year. These returns are more of governance filings. So they go over the information about who the directors are, who the officers are, where the address is, and all that stuff. So they're not returns that we here at Henry Warren typically assist with, other than advising our clients that they are required. But lawyers are often able to assist with the filing if needed. Both of these returns are very important to keep up to date on, because if you fail to file 3 consecutive years worth of returns, the incorporating body can involuntarily dissolve the not-for-profit or registered charity, which would cost money to get it back up and may jeopardize the registered charitable status for that time if you are dissolved.
So let's say that there was a change to the board of directors throughout the year. How do we go about updating CRA when that happens?
Yeah, so I actually get this question a surprising amount. I think this is something that a lot of not-for-profits are unsure of how to do. So to update CRA, you actually have to go back one step. So the first thing that CRA requires to update the directors listed with them is that your incorporating authority, so here we've been talking about federal or Ontario, would need to be updated first. So just like we talked about how you can file an annual return where you confirm who the directors are, you can also at any time during the year file a notice of change, which will then update those directors listed with your incorporating authority. And then ideally, in a perfect world, the CRA would also be updated automatically. Now, from the time you update either federal or Ontario, whichever one you fall under, it often does take a couple days for the CRA to be updated. And unfortunately, the system is not perfect. So sometimes it is actually missed. So if the CRA does not automatically get updated after you've updated it in your incorporating authority information, you will need to write to the CRA to ask them to update in their records the directors. You can't just skip right to this step or they won't update the directors because they do confirm that who you are asking them to update also agrees with what the incorporating body currently has. If your directors want to be able to access my CRA business account, you will regardless need to write to the CRA because the incorporating bodies do not request director SIN numbers. But if the director wants to obtain access, the CRA will have to have their SIN on file to be able to verify they are who they are.
So just on the topic of accessing my business account, how do we obtain CRA access for an MPO?
Yeah. So the CRA considers all directors of a corporation to be the owners of that corporation for a not-for-profit. So we're going to talk here about the owners of the corporation being the directors. So that is just a distinction made by the CRA because the directors do carry responsibilities and liabilities for the organization they are representing. So once the CRA has been updated and has all the directors' information listed, any director can go ahead and phone or write to the CRA, not emails, but either paper, mail, faxed in, or uploaded to represent a client. And the CRA should action that correspondence from them or provide information to them over the phone. The director will need to verify some information about the organization. So it's often handy to have a copy of the prior year tax filing handy, whether that is a T2 or a 10 or a T3010. My business account is very similar to my account for individuals. So if you're familiar with that, this is essentially the corporate version. For an owner or a director to get access to my business account, the CRA, as we said, has to have their SIN on file. Once they have their SIN on file, the director can go through the prompts on the CRA's website and set up a My Business account. The CRA will first need to confirm that the director is who they say they are, and they will do that by confirming information from their most recent personal tax return. So that personal tax return information will not be linked with the not-for-profits business account, but you do just need to do it because they have your SIN on file and they want to verify you are who you are. Once you've passed that first stage of authorization, you will then be able to get access to your organization's My Business account. We are greatly encouraging all our clients, both not-for-profit and for-profit corporations, to get My Business account set up. And I would recommend for a not-for-profit, at least 2 directors have it set up. So there is some continuity there in case one person is away and access is required. The CRA is moving away from traditional paper mail and will be in the future only sending mail electronically through the My Business account. So that's why obtaining authorization now is so important. If you want your not-for-profit employees or volunteers to obtain access, they're not considered owners of the corporation like a director is. So they can't be set up through my business account. So they would have to go through obtaining authorization, like we external accountants obtain authorization by setting up a rep ID. And then once you have your own rep ID, you can be an authorized representative for the NPL. The CRA changed the rules for how an authorized representative can get access within the last year or so, and we can no longer just file a form and that will automatically give us full online access. So instead, a director will actually have to log into my business account and verify or just authorize the representative of the employee or the volunteer. So that's why it's also so important for the directors to be setting up my business account.
So switching back gears to taxes a little bit, does an MPO have to charge and remit HST?
So it's very specific. It all depends on the type of revenues your not-for-profit or registered charity is earning. And there are specific rules for each type and each circumstances. So it's very individual and it's something you really just need to analyze for each revenue stream, either yourself or with the assistance of an accountant. The general rule of thumb is you should consider that you have to charge HST until you find an exception. So I would recommend for most not-for-profits that they just don't assume every revenue source is not subject to HST, because that is definitely not true. So you'll want to do your research and you'll want to continue to do your research as revenue streams switch. One exception from how HST is treated for a for-profit corporation is that for a not-for-profit that is required to register for HST, the small supplier rule is actually $50,000 instead of $30,000. So if you are a not-for-profit that does have to charge HST, but the cumulative of those revenues in any four preceding fiscal quarters is less than the $50,000 threshold, you are okay to not register and not charge and remit HST as long as you remain under that $50,000 threshold. If you are a registered charity, so not just a solo NPO, but if you're a registered charity that is an NPO, there's a specific rule also for registered charities where you have to remit your HST using the special net tax calculation, and that's what they actually call it. So it's a good rule to be aware of and that it exists because this rule actually allows registered charities in most cases to retain some of the HST they have collected and not have to remit the full amount to the government, which is great because it's more money in the hands of the not-for-profit.
Okay. So then on the flip side of that, does an NPO get to claim HST input tax credits?
Right. So an HST input tax credit is money we go out and spend. And it's the HST we spend when we incur expenses. So let's say your not-for-profit goes to Staples and buys $100 worth of office supplies, but when you go to pay, it's actually $113 because of the 13% ITC. So the question is, what do we do with this $13 or the 13% of the input tax credit we have paid? So it depends. So you have to first understand what your responsibilities are as far as charging HST if you have any taxable supplies. If you have a taxable supply, which is revenue subject to HST, then you can claim the ITCs related to those supplies. So you could claim the full 13% back as long as it's related to that revenue stream. If you are a registered charity, again, you'll have to look at the special net tax calculation because you will have to adjust the amount of ITCs under that calculation. For some expenses, if you're only charging HST on some of your revenue streams, but not all of your revenue streams, you'll want to understand how your expenses are allocated to those different streams because you can only claim ITCs on taxable supplies the traditional way. So if you have sources of revenues that are not taxable supplies, any expenses related to incurring those, you're not going to be able to claim the ITC under it traditionally. If you have shared expenses such as rent, you'll have to allocate that rent expense to your different revenue streams along with the ITC to understand what you can recoup from the government. If you are a not-for-profit and you don't charge HST, or you don't charge HST on some sources of your revenue, you may be eligible to recoup some of that ITC paid through the public service body's PSB rebate. If you are a not-for-profit that is not a registered charity, to qualify to recover ITCs under the PSB rebate, you need to be receiving at least 40% of your revenues in any given year from government sources of any level. So municipal, federal, provincial in Canada. If in one year you're over 40% of government revenues and the next year you're under 40% of revenues, that will cease the ability to claim the PSB rebate. So it is something, if your funding fluctuates year to year and the makeup of that funding fluctuates year to year, you'll want to for sure understand where you fit for any year for the PSB rebate. Registered charities, who are, of course, not-for-profits, a registered charity automatically qualifies for the PSB rebate. That doesn't mean if your registered charity is collecting is charging HST on taxable supplies, you can't still claim 100% of the ITCs. You would on those revenues, but the revenues that are not subject to HST as a registered charity, you would be able to claim those ITCs under the PSB rebate. The PSB rebate depends based on where the supplies are purchased, but for supplies purchased in Ontario, the PSB rebate allows you to recover 50% of the 5% GST included in the HST rate and 82% of the 8% PST included in our 13% HST rate. So it's really important to understand not only your responsibilities to charge HST, but how you could actually, as a not-for-profit or registered charity, recover some of the HST you have outlaid to allow more money to go back into the mission of the organization.
Okay, so I think that covers all the topics that we had today. Megan, thanks so much for going into such good detail on those items. I think at this time we'll open the floor, and if anyone has any questions, we'll field those now. Okay,
Yeah, so
so Megan, go
those
ahead, Megan.
questions can just be submitted over the Zoom question field if there are any.
Okay, so I think we do have one here. So this attendee says, this all sounds complicated. When working with an accountant, how much of this can they take off our plate?
Yeah, so us at Henry Warren, we would definitely assist in all aspects of this presentation. But it is important to understand that the underlying responsibility lands with the board of directors and management of the organization to also understand your own responsibilities. So for our clients, we can review with them the incorporating document and the requirements related to their financial statements and take them through that analysis and what needs to be done as far as minuting their decisions to make sure they are on side with their incorporating authority. We would, of course, help you complete all your various tax filings. And then here at Henry Warren, we actually have an HST expert who is able to research the more complex intricacies of the HST regime for our not-for-profit and registered charity clients. So to answer your question, Mike, we can definitely assist a lot and help navigate the complexities of running a not-for-profit.
Okay, that's great. We do have another question here. Are membership fees subject to HST?
Sure. So membership fees are obviously a large source of revenue for a lot of our not-for-profit clients. And so this is a question that commonly comes up, but unfortunately it's not a simple answer. So I can't say yes here and I can't say no. Membership fees are subject to HST depending on the benefits received under the membership. So let's think about like a membership fee to Costco. That allows you to shop there for what they believe is discounted prices. So that membership fee is subject to HST. If your membership fee is more in the realms of only providing basic benefits to the members, which would be ability to attend meetings, ability to vote as appropriate, those types of benefits, then your membership fee may not be subject to HST. So it's a very good question, but it's a very specific question where we would have to look at the factors and what rights and privileges come along with those membership fees before we can definitely say if they are subject to HST or not.
Okay, perfect. Thanks again, Megan. So I think that's all the questions that we have. So we'll conclude it here. So thanks to everybody for joining us today, and thanks to Megan for walking us through these interesting topics. And hopefully we'll see everyone at the next webinar session.
And thank you, Mike.
Thank you. Bye.